In the spring of 1946, the United States government sat beneath a mountain of debt so large it had never been seen before in American history. The country had just finished the most expensive war ever fought. It had built the largest military force ever assembled. It had borrowed money at a pace that, by the end, had pushed the national debt to 106% of the entire U.S. economy. Every dollar America produced in a year, the government owed in debt. And then something remarkable happened. Over the next 3 decades, that mountain shrank. Not slowly, not painfully, dramatically. By 1974, the debt to GDP ratio had fallen from 106% all the way down to 23%. One of the most extraordinary fiscal recoveries in the history of any modern nation. Politicians have been telling that story ever since, as proof that America can always grow its way out of debt, as evidence that the U.S. is different, that what looks like a crisis is really just a temporary detour, that we've been here before and we found our way out. But here is what they don't tell you. The conditions that made that recovery possible, every single one of them, no longer exist. And the country is approaching that same debt level again, this time without any of the tools it used to escape. America's debt held by the public has now crossed 100% of GDP for the first time since those World War II years. The gross national debt stands at $39 trillion, $114,000 for every American alive today, $289,000 per household. The Congressional Budget Office projects it will reach 108% of GDP by 2030, officially breaking the World War II record. And within a decade, Brookings Institution projects it hits 137% under current spending and tax policy. Those are not apocalyptic fringe estimates. They are the institutional consensus. Stay with me. Because the story of how America escaped its last debt crisis contains a precise lesson about why this one is different. And that lesson is the most important thing I can show you today. Let's go back to 1946. The debt peaked at 106% of GDP. Over the following 3 decades, it collapsed to 23%. The standard explanation, the one you hear from politicians across the aisle, is that America grew its way out. That the post-war economic boom was so powerful, GDP expanded fast enough to shrink the debt ratio even as the absolute dollar amount stayed large. And that part is true. The economy did grow. From the late 1940s through the late 1950s, annual real GDP growth ran at roughly 3.75% per year, consistently, year after year. But here is what most people, including most economists, have gotten wrong about that period. A team of researchers publishing through the IMF went back and ran the numbers carefully, and what they found is striking. If you remove economic growth from the equation and look only at what growth contributed to the debt paydown, the ratio would have fallen only to about 74% by 1974, not 23%. Economic growth accounted for a fraction of the recovery. The rest came from 3 other factors. Budget surpluses, years where the government actually collected more in taxes than it spent. Surprise inflation, which eroded the real value of the outstanding debt. And financial repression, the Federal Reserve pegging interest rates below market levels for years after the war, which held down borrowing costs while inflation ran hot, effectively transferring wealth from lenders to the government. Those 3 mechanisms worked together for 30 years. They were not accidents. They were policies. Deliberate, coordinated, sustained policies that required a specific set of conditions to operate. And those conditions were extraordinary. America in 1946 had just demobilized from the largest military buildup in history. Defense spending plummeted almost overnight, freeing up enormous fiscal space. The baby boom created a surge of new workers, new consumers, new taxpayers entering the economy through the 1950s and 1960s. Europe and Asia lay in ruins, which meant American manufacturers faced essentially no competition for global market share for a decade. Corporate investment flooded into factories and infrastructure, and there was enormous pent-up consumer demand. 15 years of depression and wartime rationing had left American households desperate to spend. Now sit with that picture, and then look at 2026. The federal deficit this year will be approximately $1.80 trillion. There are no budget surpluses anywhere on the political horizon. The mandatory spending commitments, Social Security, Medicare, Medicaid, interest on the debt now consume 75% of the federal budget. Discretionary spending, which is every other program combined including defense, has been squeezed to just 13%. Within a decade, Brookings projects interest payments alone will consume more than 30% of all federal revenues. By 2040, net interest is on track to be the single largest line item in the entire federal budget, eclipsing Social Security. Think about what that means. The largest expense the U.S. government has, larger than its military, larger than retirement payments to its citizens, will be the interest it pays on money it already borrowed. That is not a spending problem, that is a structural trap. Now let me show you the second condition that made the post-war recovery possible and why it's gone. After the war, the Federal Reserve pegged interest rates at low levels for years. This was a deliberate arrangement between the Treasury and the Fed. The government needed cheap borrowing costs. The Fed agreed to provide them, essentially setting rates where the Treasury wanted rather than where the market wanted. This is called financial repression. It held borrowing costs down artificially, even as inflation ran above those rates, which meant lenders were earning negative real returns. In plain English, bondholders were slowly losing money in real terms, and the government was quietly benefiting. That arrangement ended with the Fed Treasury Accord of 1951. But for the critical 5 or 6 years after the war, the years when the debt ratio needed to peak and begin declining, the Fed was not independent. It was cooperative. Now look at the Federal Reserve today. Under new chair Kevin Warsh, the Fed faces a completely different mandate and a completely different political environment. Interest rates have been held between 3.5% and 3.75% since December 2025. The market is pricing a roughly 70% probability of at least one rate hike later this year. And critically, there is no post-war arrangement, no agreed coordination between Treasury and Fed. The Fed is independent, politically pressured on one side and constrained by inflation on the other. It cannot simply agree to hold rates below inflation for 6 years to help the government delever. And that matters enormously, because the interest rate environment is the single most important variable in whether America's debt is manageable or catastrophic. Here is why. The U.S. currently carries approximately $39 trillion in debt. The annual interest bill on that debt has already crossed $1 trillion. That is more than America spends on its military. It is more than it spends on Medicare. It is for the first time in U.S. history the single largest non-mandatory outlay in the federal budget. And that bill was calculated at today's interest rates. If rates rise because foreign creditors grow nervous, because the Fed hikes to fight inflation, because demand for U.S. bonds weakens, that annual interest bill climbs. Every percentage point increase in average borrowing costs on $39 trillion adds roughly $390 billion to the annual interest expense. That is not a risk on the horizon. It is a risk that is already arriving. In May of 2025, Moody's did something it had resisted for decades. It stripped the United States of its final AAA credit rating, downgrading sovereign debt to AA1. Standard & Poor's had done it first in 2011. Fitch followed in 2023. Moody's held out until it could no longer justify the rating in good conscience. Its statement was direct. The downgrade reflects the increase over more than a decade in government debt and interest payment ratios to levels significantly higher than similarly rated sovereigns. Successive administrations and Congress, it said, have failed to agree on measures to reverse the trend. That was the last major rating agency. America now has no AAA rating from any of the three that matter. In the immediate aftermath of the Moody's announcement, a routine Treasury auction of 20-year bonds showed troubling demand. The yield jumped to 5.047%, the highest since November 2023. The bid-to-cover ratio was weak. That is the market quietly signaling that it wants to be compensated more for the risk of holding American debt. Now let me break down what a weak Treasury auction actually means, because this is the mechanism most people don't understand, and it is the mechanism that connects everything. When the U.S. government needs to borrow money, it holds auctions. It offers new bonds to investors, domestic funds, foreign central banks, primary dealers, and investors bid on them. A strong auction means lots of bidders competing aggressively for the bonds, which keeps yields low and borrowing costs cheap. A weak auction means fewer bidders, less competition, and the government must offer a higher yield to attract enough buyers. Now, the United States needs to run these auctions constantly, not once a year, not once a quarter, constantly, because it is running a $1.80 trillion annual deficit. It needs to sell new debt every single week to keep the lights on, and as existing debt matures, comes due, it must also refinance that debt, issuing new bonds to replace old ones. The Treasury has been managing this by issuing a large proportion of short-term debt over the past several years, bills that mature in months rather than decades. That kept immediate borrowing costs low when short-term rates were low. But here is the problem that is developing right now. Those short-term bills are coming due. They need to be rolled over into new debt, and they are being rolled over at today's higher rates. The average interest rate the U.S. pays across its entire debt portfolio is rising slowly but consistently as old low-rate debt matures and gets replaced with new higher-rate debt. This is called the refinancing wave, and it is one of the most underreported fiscal pressures in the country today. Former Treasury Secretary Henry Paulson described it in April of this year with unusual candor. The scale of U.S. borrowing, he said, is severely testing confidence in the country's ability to keep financing itself. One victim of that spiral, he warned, would be the Treasury market, not because America can't technically pay, but because the question of whether it will always be willing to pay and at what cost is no longer as obviously settled as it was. Now, here is the part Washington most reliably avoids discussing. The playbook America used after 1946 had one additional ingredient that nobody likes to talk about: inflation. The IMF researchers found that surprise inflation, meaning inflation that exceeded what bondholders had expected and priced in when they bought the bonds, was responsible for a significant portion of the debt reduction. Because inflation doesn't just raise prices at the grocery store, it also erodes the real value of outstanding debt. If you borrow $1 today and inflation runs at 5% for 5 years, the dollar you pay back in 5 years is worth considerably less in real terms than the dollar you borrowed. The bondholder loses purchasing power, the borrower benefits. After World War II, the U.S. ran this mechanism for years. Bondholders who bought Treasury debt in the 1940s earned nominal returns but lost ground to inflation in real terms. That transfer of wealth from lenders to the government was a quiet, invisible, politically painless way of reducing the debt burden. It required no legislation, it generated no headlines. It just happened slowly in the background while the economy grew and the debt ratio fell. And this is the tool I believe the United States will reach for again. Not explicitly, not honestly, not with a press conference where any politician stands up and says we are going to inflate away the debt, but structurally, mathematically, by allowing inflation to run somewhat above target for an extended period, by keeping real interest rates modestly negative, by not tightening aggressively enough to kill the inflation entirely, while simultaneously benefiting from the erosion of the debt's real value. The Federal Reserve will not call it financial repression. It will not call it intentional. It will call it a difficult trade-off, a challenging environment, a balance between price stability and financial stability. But the outcome will be the same as it was after 1946. Inflation that runs above the returns available to bondholders in real terms, and a slow, quiet transfer of purchasing power from people who hold fixed income savings to a government that owes too much to pay back honestly. That is the prediction, not a crash, not a default, not a moment of dramatic reckoning, a slow erosion, a long grinding period in which the nominal numbers look fine, but the real value of what you hold declines. The debt gets managed. The economy keeps running. But the measuring stick gets quietly shorter. And here is the part that matters most for anyone watching this. This process, financial repression, inflation running above what fixed income pays, is historically brutal for certain kinds of assets and historically generous to others. It destroys the real value of cash savings. It punishes long-duration bonds, which are exactly what the government is asking you to buy. It hammers fixed income portfolios and pension funds that are loaded with treasuries. These assets have nominal returns, but if inflation persistently runs above those returns, the real purchasing power declines year after year. On the other side of that ledger sit real assets, energy, commodities, hard assets with intrinsic productive value, and gold, which is simply the market's way of voting that the measuring stick has gotten shorter. Gold peaked above $5,600 an ounce in January of this year. Central banks, which understand this mechanism better than any other category of investor, have been net buyers of gold for 4 consecutive years. In 2026, the World Gold Council found that 45% of central banks globally plan to increase gold reserves over the next 12 months. These are institutions whose job is to preserve the value of national savings, and they are diversifying out of the thing that is being inflated and into the thing that can't be. That is not coincidence. That is institutional memory. These institutions remember 1946. They remember how governments deal with too much debt, and they are positioning accordingly. Now let me return to the comparison one final time. because there is one crucial difference between 1946 and 2026 that changes the difficulty of the problem enormously. In 1946, America had just won a war. The source of the debt was universally understood, broadly accepted, and politically finished. Nobody was arguing to spend more on World War II in 1947. Military spending collapsed, surpluses followed, the political will to restrain spending existed because the reason for the spending was over. Today, the sources of the debt are not over. They are structural, permanent, and growing. Social Security and Medicare costs are rising as the population ages, not falling. Defense spending is rising with a more dangerous geopolitical environment, not falling. Interest costs are rising with the debt itself, compounding, self-reinforcing. And the political system, as Moody's itself observed, has demonstrated a decade-long inability to agree on any meaningful path to fiscal restraint. That is the difference. In 1946, the problem had a natural ending. In 2026, the problem has no natural ending. It only has a chosen one. And every year that choice is deferred, the cost of eventually making it rises. The last time America's debt was at this level, it had a world war to explain it and a post-war boom to escape it. This time, it has neither. What it has instead is a set of tools, the same tools it used after 1946, financial repression, inflation, managed erosion of real returns, and a Federal Reserve that will eventually, under whatever name it chooses, deploy them, positioned for that world, not the one in the textbooks, the one that is arriving. The debt crossed 100% of GDP this spring. The World War II peak is approaching. The tools available this time are narrower, and the political will to use the harder ones is, at this moment, nowhere to be found. History doesn't repeat, but it rhymes with remarkable precision. And right now, it is rhyming very loudly.